the way I think most of us are taught to invest is some version of dollar cost averaging, right? Which is like if you just invest a little bit all the time over the course of many years, you pay more for stocks during those big bubbly markets, and then you pay less for them during those grinding bear markets, and they sort of balance themselves out, right? When should an investor think about doing something different? When does it make sense to just deviate from that and look for a product that either offers some form of insurance or some uncorrelated return? Like when does it make sense to deviate?
Oh, well, now the second one is something I sell.
Right.
So I feel very differently about that.
Okay.
That won't be too self-serving, I'm sure.
I mean, we
Tell
asked
us
you on
more.
the podcast,
Yeah.
so here we are.
When to hedge, really, it's kind of a smart-sounding way to say when to time the market.
Right.
Right?
That is such a good point.
Because a hedge is, if you have a hedge on all the time, you're not timing the market, you're building a buffered product. But if you're doing it sporadically, you're timing the market. And, I have great cynicism that the average investor should be trying to time the market. There'll always be someone who gets it right. In some cases,
and they'll brag about it, like on Reddit,
yeah.
and entice
And
everybody
the world's
else to
very
do
good
it,
at
right?
ex-post finding the few people who got it right and telling you that they're the next geniuses. I think I've been on the good and the bad side of this PR over time. It's one's more fun than the other, but both are silly. I don't think for the average investor there's really ever a time I would say time the market, and certainly not to hedge the short term. I do believe that very long-term returns, kind of 10-year returns, are higher when markets are cheap versus history and lower when markets are more expensive versus history. Doesn't always work. Even over 10 years, it can be wrong. And even there, you don't seem to add a lot of value. Very often, if markets are expensive, the rational prediction is they'll make kind of half of what they normally make. I will now, in a very different sense of the word, hedge a little bit. We do believe in trend following strategies. Those do take market positions, and you could call that a form of market timing. But they're based on an actual empirical relationship that when this happens, this usually happens. I think the average investor out there, when they're nervous, they might actually be wanting to do the opposite of what they're feeling. But if they just do nothing, I'll be happy. I think that's pretty good. That's a win.